UBS Asset Management out with a note to clients today emphasizing the need for a diversified portfolio due to increasing economic growth risks. Evan Brown is behind the note. He is the firm's head of multi-asset strategy. Evan, welcome back. Good to see you. So was Friday the beginning of a growth scare in your view?
I mean, it was jarring to see, 150,000 3-month moving average drop to 35,000. And we've been of the view, I think everyone's been of the view that there's going to be a soft patch and we're in it. But if you're slowing that quickly, that raises the potential that something breaks. There's some kind of shock, and then you get a bunch of layoffs. We're not seeing that in the data right now, but we're getting dangerously close. And so we talk about buying dips. Look, we're still constructive on the stock market. We think things will hang in, but we'd rather be buying dips in bonds right now as insurance for that potential scenario.
So what are you looking for? Are you waiting for the next jobs report as your data point? I mean, what sort of signals to you that we are beyond the point?
Well, I think the encouraging thing is that jobless claims, not only have they been stable, they've actually been coming in lower. So that gives us some peace of mind. It makes sense, in fact, that over the last few months after Liberation Day, May, June, there was a slowdown in hiring and maybe some layoffs. But since then, as things have settled down, those layoffs have come down, and you've seen that in initial jobless claims. So that, I think, is the best real-time data that we get in high-frequency tracking the labor market, and so we'll be focused on those.
So, Evan, if you're looking at buying bonds, what's the traditional split? Used to be 60-40. Yeah. It sounds like you're more aggressive on bonds. What would you think this split should be now with the environment we're in?
Look, I think so. I would still be overweight equities versus bonds, right? But the portfolios that we run, we have leverage, right? So we can be overweight equities and bonds at the same time by borrowing in cash, and so that's kind of how we see it. With that, for the retail investor, it's that extra cash that you have on the sideline. The next move, just to diversify a little bit, would be into bonds.
So thanks for being here. When you think about bonds and you think about corporate credits versus treasuries, is there enough credit premium that you're getting?
Not really. There's really, I mean, with an IG, about 80 basis points of a spread. We're at the lows. I don't think that widens out too much because I don't think we get if we do have a recession, I don't think we have a big recession. But there'll be some widening there. And I just don't think you're compensated enough. So I would stick with treasuries, yeah.
Evan, help us understand then the process and the sequencing almost of asset allocation. Say we have another terrible number in the first week of September on the jobs front. What does that do inside of your investment committee? How do you make those adjustments? And let's just hypothesize another terribly weak jobs number in the first week of September. How does that affect your asset allocation here?
Yeah, so the idea is that we're well diversified ahead of these events so that we don't have to chase. And I wish I could have told you that I knew that those revisions were coming and that we bought a bunch of bonds right before Friday. We didn't, but in fact, we were looking for a little bit of a rise in yields to buy into.
But it would imply that the world's different than what you thought before you went into that period.
Definitely. I think we'll get mixed data over the coming weeks ahead of that next jobs number. And I think we'll get a pickup in bond volatility. So bond vol is extremely low right now. I think it should pick up a little bit with all the moving parts in the economy. We haven't even talked about inflation yet here. And so say inflation comes in a little bit hot and you get yields moving higher, we would be using that to add some before the next labor print.